mode.
Good afternoon, everyone. Welcome to the FIG Securities webinar on our retail model portfolio. My name is Simon Michel and I'm a Director of Fixed Income Sales, and I'm joined by Justin McCarthy, Director of Financial Institutions and Corporate Research based in Brisbane. A little bit of housekeeping. You will see on your screen to the right hand side you should have an instruction box, and on that box is an area for questions. Please feel free to type in any questions throughout the presentation, and we'll attempt to get through them through the presentation. Alternatively afterwards, or if it's a little bit more detailed, we'll give you a call and run through that with you one-on-one. Okay, we'll launch into it. Today we're just going to run through a little bit about FIG for those of you that aren't familiar with us, and then get into the strategy and selection process around the preparation of the retail model bond portfolio. We'll look at the current bond portfolio we have out on offer at the moment, the key benefits, and then through the offer and order process. And as mentioned before, we'll get stuck into some questions afterwards. So FIG Securities has been around for 15 years. We're Australia's largest fixed income specialist, providing access to government, corporate, semi-government, inflation-linked bonds, as well as term deposits across 60 different Australian authorised deposit-taking institutions. We have around about $9 billion in funds under administration. About $8 billion of that is through our term deposit business. And we have offices in Brisbane, Sydney, Melbourne and Perth, and a dedicated specialist fixed income research team, of which Justin is a part, based in Brisbane. And we're working in close partnership with financial advisors to provide direct fixed income to their clients. Now I'll pass on to Justin, who will run through the strategy and selection process. Justin.
Thanks for that, Simon. As Simon mentioned, I'm a director in the research team, and as part of that role we've certainly been heavily involved in setting up the strategy and selection process. You might also think of that as a mandate in sort of funds management terms. And what I'm going to do today is just briefly go through that process, or mandate if you like, and then focus just a little bit on the current portfolio with some of the key statistics. Then I'll hand back over to Simon, who will go through the process if you're actually wanting to transact. So on this first slide, we've got the base investment objective, and that's to provide for retail investors a diversified portfolio of bonds that are conservative in nature, but producing very reliable cash flows and superior returns to term deposits. So we're getting a lot of investors coming to us more and more now as term deposits are falling in rates into the 4s and even the 3%. And what we're finding is that there's a strong demand for something with a little bit higher return. The 2 points below that are very important. Preservation of capital are very important. So investors in this space are looking for safety, and also that reliability of income or cash flow, very important or paramount. And for that reason, you'll see in slides to come there's a high allocation to senior or senior secured bonds. So that means they're very high up in the capital structure. Another term you might associate with that is vanilla bonds, very safe, secure, straightforward. A very simple benchmark, and there's a number of different ways we can look at this, but we've set out just a benchmark of the RBA cash rate plus 1%. So at the moment that's quite low, I guess. 2.5% plus 1%, 3.5%. You'll be, I'm sure, glad to know when we get to the actual details of the current portfolio, the return is close to around 5.5%. So it's not round in the 3s and 4s like the term deposits. So significantly beating those. If we go over to the next page, we'll go through, I guess, the key areas or the key strategy and selection process criteria. The first is that, what is the investment universe? What are the authorised investments that we can choose from? So being a retail portfolio and a target spend of around $50,000, what we have is a list of retail bonds that are available in face value or parcel sizes of $10,000. Now that list at the moment is around 22 bonds. I think over time that will increase. On top of that, there is also the potential for a number of government and state government bonds to be included in parcel sizes of 10,000, and that's quite a new development in the bond market. Many of you will know that most bonds can only be traded in $500,000 parcels. FIG created access to the market in $50,000 and $100,000 parcels around 2 or 3 years ago, and just recently we've lowered that limit to $10,000 for that select list of around 22 bonds. So how many bonds go into the portfolio? With a minimum of 10,000, we've chosen 5 bonds, so around $50,000 face value or $50,000 spend. Larger portfolios can certainly be provided, so you could have 6 or 7 bonds of 10,000, or certainly that these bonds can be purchased in $50,000 or $100,000 lots. So if you were comfortable with this portfolio but wanted larger amount, that certainly can be done in a number of ways. Minimum security rating. Now, the important thing here is ASIC actually prevents us and advisors from telling retail customers the credit rating, albeit I'm not sure it's the most sensible policy. It is a law that we cannot advise retail investors the actual rating, but we are able to tell them what a mandate or what the requirements are in setting up a portfolio. So in order to go onto this list, each individual bond in order to go into the portfolio, each individual bond must be rated BBB or better. And when we do the portfolio analysis, we have to have an average or a minimum portfolio weighted average rating of BBB plus or better. Now, we've chosen BBB or better because once bonds go into sub-investment grade, which is generally BB plus or lower, they tend to fall in price because there is quite a big drop-off in mandates or investors, large funds and managers who cannot hold sub-investment grade bonds. But that also starts to happen when you get down to the BBB minus, because all of a sudden you're on that cusp. So what we've done is built in a buffer of 2 rating notches. So if a bond that was in the portfolio was to fall from BBB to BBB minus, we would advise all advisors, all holders, and make recommendations for changes to that bond or a substitution. It's up to the individual investor or advisor whether they actually proceed with that. If we go over to the next slide, you can see that we've got some pretty simple criteria around how much exposure to any individual bond and any individual issuer. So essentially we've got a 30% exposure to any individual bond. The reason that that's not 20%, because we do have 5 bonds, is some of the bonds that we include, particularly the inflation-linked bonds, which we'll touch on a little bit later, they actually accrete in value, so the face value increases over time. So when we get to the portfolio, you'll see the Sydney Airports bond, the face value of that is actually around $125 as opposed to $100. So we've just built in a little bit of a buffer there. But the key thing to realise is that no individual bond can be more than 30% and no individual issuer. So you couldn't have, in that case, say one bond from National Australia Bank and another bond from National Wealth Management. We would consider that as too much exposure to one issuer, being the NAB group. The next point there on capital structure parameters is fairly important, and you'll see the way that works is there's 3 components. There's senior debt or senior secured debt, subordinated debt, and Tier 1 or hybrid securities. What we've done here, because it is a conservative portfolio, we've said that there must be at least 60% exposure to senior debt, so way up high in the capital structure. So vanilla bonds, no call risk. It's all about safety, and ensuring that there's reliable cash flows, no ability for those interest payments to be deferred, those sorts of things. Then there's a ability to have up to 40% in subordinated debt, and you'll see in the existing portfolio we do have around, I think it's 38%, but 2 names in subordinated debt, and that has to be based on a relative value assessment. So we'll only go down into subordinated debt if we think you're getting paid for the additional risks. But importantly, there's no exposure to Tier 1 hybrid securities permitted in this portfolio, and that's because we're looking at a very conservative portfolio. We don't want, now while we're comfortable with a number of these Tier 1s that we do sell to wholesale investors, we think it's a very conservative, safe portfolio, so it's better just to stick to the senior debt and subordinated debt, which in its very worst case scenario still has a defined maturity date, as opposed to the Tier 1 hybrid securities, which in theory are perpetual, can go forever. In terms of the weighted average maturity, that we have a relatively long ability to go out to weighted average maturity of 8 years. The reason we've chosen 8 years is because we would like to include, and we have in this first iteration of the retail portfolio, I'd like to include some of the inflation-linked bonds, which tend to be quite long dated. 2020 or 2030 is as a maturity date is not uncommon. So the maturity profile of these portfolios might be a little bit longer, but you can rest assured that a lot of that is protected, being inflation linked. If we move over to the next page, liquidity is obviously very important. All these bonds must be on what we call the FIG Securities Direct Bonds list. That is essentially a list of bonds that are cut into smaller parcels of $50,000 or $10,000 limits, and by virtue of being on that list, that typically provides very strong buying demand from our existing client base, and we've particularly found that with the $10,000 bonds, which is quite a new development. It's really opened the market up to a number of retail customers who may not have been able to invest previously. So we're finding as soon as we can find some of these bonds, there's very strong buying demand. So liquidity is quite important for investors in all cases, and particularly bonds. Diversity, as I mentioned earlier on, we've chosen a minimum of 5 bonds, and they tend to come from various industries, but being a conservative portfolio, we've got a bias to Australian companies, and that in particular provides less exposure to international market forces, so particularly what's happening in the UK and the US, which has really driven a lot of the volatility in the market since the GFC. We've got a bias to strong Australian companies, and particularly in the infrastructure or essential services space. So you'll see that a number of those investments in the current portfolio are in the infrastructure area. Research overlay and value overlay. Essentially that means that on the research front, everything that goes into the portfolio must first pass through the FIG research process. So obviously we've got to be comfortable with it, we've got to like it, and it also includes the publication of a full research report. So investors or advisors can rest assured that everything that's in the portfolio will be fully covered and have a detailed research report that's available to yourselves and can be passed through to your customers or clients. The value overlay, I guess like everything, there's two sides to the equation. There's risk and then there's also return. So we are also looking for we're also looking for a very strong return component. So we're not just saying, okay, we'll just put anything that's low risk in there. We need to be confident that you're getting paid for that risk, and that's particularly the case when you come to the subordinated debt. If you're moving down that capital structure, we want to be comfortable that you're getting rewarded for that extra risk that you're taking on. So having gone through the process, what does the current retail model portfolio look like? There's, as you'll notice here, there's 5 names. What I might take you to first is the second last column, the gross yield to maturity. That's probably the main column that we look at in the bond market for comparing returns. So that is the expected return that you'll get on an annual basis if you hold each of these bonds to maturity. If you can see the column to the left of that, that is running yield, and that is actually the income component that you'll get each year. So that's simply the money that will hit the bank account divided by the price that you'll pay. The difference between the running yield and the gross yield to maturity is the capital gain or capital loss. So if you'll see, for example, the Sydney Airport, you're getting a running yield of 3.83, but the gross yield to maturity is significantly higher at 6.55. A large component of that difference is that you are buying those bonds at a discount, and when they mature, you'll get a capital gain. So looking at the gross yield to maturity, you'll see that the Sydney Airport bond is the highest yielding there. But that's also an inflation-linked bond with a maturity date of 2020, so one of the quite long dated bonds that I was talking about a little bit earlier. But you are protected with the coupons being, well, the capital and the coupons being linked to inflation. So how a capital index bond or this particular inflation-linked bond works, if you bought it, for example, it was issued at $100 and inflation was 5%, at the end of that first year, you'd actually have $105 of face value. So if it was to mature at the end of that first year, which they are never issued at just a one-year bond, but if it was, you would actually get $105 back for your $100 invested. That is quite unique, but it does give a very strong protection against inflation. The next bond there is Southbank Institute of Technology. That's what we call a public-private partnership. It's actually the Southbank TAFE up here in Queensland, and it has a income stream that comes from the state government, so they're paying the rent. That bond has got a 2018 call date, but potentially can it be extended for 2 years to 2020. That's a senior bond paying a gross yield to maturity of 5.05, but the running yield is a little bit higher, being 6.22. The reason that the running yield is higher is because it's a fixed rate bond paying a very good coupon, so that the price is actually at a premium, $106 if you're $106.80 if you're to buy it now. When it matures, you'll get $100 back. So that's, again, the difference between the running yield and the gross yield to maturity. DBCT, or Dalrymple Bay Coal Terminal, is another infrastructure type investment. So you'll see the first three. Sydney Airports is, I guess, we classify it as transport, but again, it's probably essential infrastructure. The GEM Southbank, or the TAFE, is, I guess, property or government infrastructure. And then the Dalrymple Bay Coal Terminal is obviously coal infrastructure. So that's the terminal for around 50% of the coal that goes in and out of Australia. It may even be a little bit higher than that now. And it's a very crucial part of our infrastructure. It's again quite a long dated bond, but unlike the two above, which are inflation linked and fixed rate, this one's a floating rate. So the coupons on those are set at a fixed margin over BBSW, which will go up and down with essentially the cash rate. So think of, it's not exactly the same, but think of BBSW or bank bill swap rate as moving up and down with the cash rate. So we think it's quite important in these portfolios to have a mix of payment types. So you've got, in this case, inflation-linked, fixed rate, and floating rate. The next two on the list, National Wealth Management Holdings and Vero Insurance, are subordinated bonds. So both of these are issued as 20-year maturity, but callable after 10 years. So you'll see that the call dates we've used, and we highly expect that these will be repaid for $100 on those call dates, for the National Wealth in June 2016 and for the Vero in September 2015. One being the National Wealth is floating and the Vero is fixed. National Wealth is a wholly owned subsidiary of National Australian Bank. In the research team, we believe this risk is akin to the NAB. We think that National Wealth is and the Wealth Management Division is crucial to the NAB, like all the wealth management divisions, to all the major banks, so we think it's very unlikely that they will not support it. In the unlikely need it's need, it is required. And Vero is in a similar position. That is a wholly owned subsidiary of Suncorp Group. And the Vero, or the insurance business, is actually the larger or more important part of the Suncorp Group. So all 5 of these bonds are viewed as quite high quality or very high quality, relatively vanilla and safe bonds, and that fits within our mandate or our requirement to have very conservative portfolio. And we've got the individual stats there. You can see the gross yield to maturity. That's the best one to line up the relative values if you're comparing to, say, maybe term deposits or other investments out there. The running yield is the income that you'll receive each year, and then that maturity or call date. So where there's a call date, we've assumed it will be called at that first opportunity, and that is the date that we've used for the average weighted length or maturity of the portfolio. So if we flick over to the next slide, we'll go through just some of the basic key metrics or the key statistics. So the portfolio, the reason for the square brackets is this is as at yesterday, but over the life of this offer, I guess, which is open sort of for 4 to 6 weeks, those figures will change a little bit, but it shouldn't be much of a difference. But you can see that yield to maturity on the overall portfolio is around 5.36, so significantly higher than the cash rate plus 1%. The running yield's a little bit lower, being 4.62, but still a very healthy income component. And one thing you should be aware of with the inflation-linked bonds, that yield to maturity assumes a inflation rate over the life of the bond of 2.5%, but that running yield will increase over time because the coupon component increases as that capital value increases. So in that case, I explained before, if inflation was 5% and it goes from $100 to $105, if it's 10% the next year, well, now you're looking at $115.50. But the coupon is ever increasing, so that running yield will increase over time. The other important part, again getting back to something I mentioned early on, was that capital structure exposure. So 62% of this portfolio is in that senior debt, the vanilla, very safe, senior secured in the case of the infrastructure assets, being Sydney Airport and the DBCT bond, and then just senior debt for the South Bank TAFE, subordinated bonds being the 2, Vero and National Wealth. So you can see that it's a relatively vanilla safe portfolio. The other key point is there's no ongoing fees, there's no ongoing charges to the investors or to the advisor. So all fees are taken out, or our commission is taken out in what we call the bid offer spread when it is first transacted. Now, if we go over to the next slide, we've got a little bit of...
Just on that point, Justin, I've just had a question come in from Stephanie actually about how FIG gets paid. So just since you were touching on that, fees or charges, I might just make the point, as Justin said, we take a bit off a spread on bonds. So essentially, when you see a bond yield quoted by FIG, it is after we've taken 10 to 20 basis points off the top of that, so there's no further fees or charges to clients, and certainly in relation to the model portfolios, there's no other additional costs.
The next slide I don't propose to run through the details, but that's really just if you want to know a little bit more information about the 5 bonds that are in the current portfolio. There's a snapshot of the credit. As I mentioned, we also have detailed research pieces on each one of these, and that's available to advisors and also to pass through to their clients. And then the final slide that I'll go through before I pass back over to Simon is just we've also developed a list of substitute bonds, or the bench, for want of a better term. And this is just a number of alternative bonds that we can provide into that portfolio if there is any problems in filling the existing five bonds. We do find from time to time that it might take a little bit longer than we anticipate to find some of these bonds in the open market. So we do have, particularly you'll see the Dalrymple Bay, rather than the 2021 bond, we could put in the 2016 bond, and that is a fixed rate bond. Again, down the bottom, National Wealth, rather than the floating rate bond, there is also a fixed rate bond. That, again, is essentially the exact same terms, other than this is a fixed rate bond with the same call date. And we've also got a third one there, being Stockland Trust, which is a property bond with a maturity of 2020, fixed rate bond with a gross yield to maturity around 5%. So from time to time, and certainly your dealer will converse with you, but if there is a little bit of a delay in getting the portfolio set, we do have a number of alternative bonds that we can put into the portfolio if required. So I'll hand back over to Simon, who's just going to run through a little bit of the offer and order process, and just how you would go through transacting, if that's what you're looking to do, and maybe some of the benefits for the advisors of the retail model portfolio.
Thank you very much, Justin. Before you go, I've just got a question here from Mark, actually. Just wanted a bit more detail on how regular you review the portfolio.
That's a great question, probably something I should have covered. We are constantly looking at these bonds every day, so if there was a credit issue with any of these bonds, we would certainly alert all the advisors and all our clients and customers. But in terms of looking at the actual model portfolio, we review that on the first day of each month, so look at redoing the pricing, looking at whether we're still comfortable with those 5 names, whether we should trade one out from a credit perspective, or indeed from a relative value perspective. If we think something has performed very well and there's something that exhibits better value, we will make a transaction. But the idea is that these things probably won't change too much. The third category obviously would be, and we're looking at this on a day-by-day basis, is if it fell below the BBB requirement, and that would be something that we'd obviously be on the front foot and advising all our advisors and clients of that. But it's a day-by-day credit look, and then the portfolio we're looking at on the first of the month each month.
Thank you very much for that, Justin. So just moving on from the strategy and selection, obviously, some of the key benefits for clients are a higher return than term deposits, up around that 5%, and also regular income. Bonds provide coupon payments either quarterly or semi-annually, so it does allow you to generate some income out of the portfolio, and also to incorporate some strategies. So Justin mentioned, fixed and floating and inflation-linked bonds that can be incorporated for particular outcomes. Obviously, this is direct fixed income, so clients open up their own custody account and have direct beneficial ownership of their bonds, and obviously have liquidity by being able to sell those bonds at any time. Obviously, we can now go down to individual bond parcels of $10,000, and our minimum entry point is $50,000, being 5 by 10K bonds. You obviously have transparency, control of your investments. We provide reporting through data feeds and online through the FIG website, and you have complete transparency of your holdings via monthly reporting statements as well. This isn't a fund, as I mentioned. You actually do buy the bonds. What we do is put a process in place to pool demand so that we can go and buy in volume and achieve a better yield outcome for clients. But once you've bought your model portfolio, you are free to make any adjustments or changes to that you see fit, or selling, or even adding on to your allocation. So obviously, managed funds have diversified across a lot of bonds, but they have one front door, and sometimes that front door is closed. So at least with a selection of bonds, you actually do have a number of triggers you can pull if you are looking to liquidate and generate some cash. As I said, we make our money on taking a spread when we sell bonds, so there are no ongoing fees or charges. You just pay when you buy a bond, and that is it. So the custody is provided for the life of the holdings, and no ongoing fees or charges. Some of the benefits for advisors, obviously we're providing efficiency through putting together the model portfolio, the application of the process and the strategy, regular reviews. So we're doing the monitoring for you, and we're providing ongoing reporting as well. Obviously, you have the flexibility to sell individual bonds included in the portfolio, so you're not locked into those bonds. Once you have your model portfolio, you have complete flexibility over adding to that, selling some out, or just holding it through to maturity. We provide data feeds through a range of options: Xplan, Class Super, Iris. We also provide online reporting via our website, and we send out end-of-month statement of holdings and valuations as well. Just touching on the data feeds there with model platform providers, and we're increasing our exposure at data feeds as well over time. So on the current model portfolio that we have out on offer at the moment, I thought I'd just run through the process or the key dates. We put a bit of time in place there because we want to ensure that it's a streamlined process and that there's plenty of time to get accounts in place, custody accounts in place for clients that would like to participate in this offer. So on the 8th of August this month, we provided the model portfolio with indicative yield. That's available for advisors to send to their clients, gauge some interest, and should there be some interest for us to initiate getting new accounts in place, custody accounts in place, ready to go. There's no charge with that, so we always suggest it's a good idea to get custody accounts in place, ready and in place for when clients may look to go ahead with any transactions. On the 28th of August next week, we will ask that all new accounts to participate in the offer are submitted, just to give us a bit of time to ensure that they're all opened and ready to go. On the 2nd of September, we'll ask for firm orders, and we'll contact advisors to get an indication of what firm orders they have, and we will confirm the bond pricing, and we will start to execute some of those orders over time. On the 16th of September, we will have executed the portfolio and provide the final price to advisors for communication down to their clients, and obviously you will receive confirmations of each separate bond purchase in the name of your underlying client, and those bonds will then be swept into the client's custody account, where they will be reported on via holding and valuation statements as at month end. The data feeds will begin, and you will also be able to access holdings via our website. So just running through that again, obviously orders are firm market orders, and we execute on firm market orders, and we fill on a best endeavours basis. So obviously by pooling demand together, we're able to buy in volume. That gives us a better ability to extract a better return from the market. It may take us a few days to execute one or more of those names while we look for supply, because we don't hold these bonds on our shelf as such. First in, first served, so orders are filled in the order which we receive them in the book build. So what it may mean is that some clients receive their bonds before others, but our aim obviously is to ensure the best outcome for all clients. Partial fills are possible. So obviously minimum parcel size is 10,000, but in the case of a client looking at doing, say, 100,000 5 by 20, it is possible we may fill half of that $20,000 with the other half filled a little later. As mentioned before, we do provide a confirmation of all bond transactions as they're filled and purchased, and settlement on all bonds is generally T+3. It can sometimes be T+4 or 5, but market convention is T+3. The process is available on our website, or you can contact one of your relationship managers here at FIG, and we can provide that through to you. So I did have a question here from Carol just about custody, but I think we probably touched on that. As I mentioned, it's not a fund as such. There's no units. Clients are actually buying and holding their own bonds in their own name in a custody account in the name of their investing entity. So that's about all the questions we've got. We ran through a few there through the presentation. We would be very happy to hear from you or answer any further questions you may have, and you can certainly contact us on the number you can see on the slide there, or your local FIG office or relationship manager if you have one. If you'd like any further details on the current model portfolio, we can send that through to you as well. We'll be very happy to provide you with that.